Hello, my name is Manny Kagan. I'm president of Pacific Bay Financial Corporation and the founder of Money Solutions Academy. Today, I do not have interview. I'm going to interview myself, and the reason is because we are vacationing in Kauai. This is not where a fire was, so people confuse. But if I look relaxed and tan, it's because I have good time here. Nevertheless, I have to let you know what's going on in finance mortgage business. Therefore, I decided to record this presentation, and it has to do with the mortgage insurance. Now, the reason for this theme is because I have to renew my NMLS designation, and for that was a class based on mortgage insurance, and I've written a letter for you, which you will read it. And I will want to tell you a little bit more about what mortgage insurance is and what it is not. Mortgage insurance allows lenders to give borrowers money when they don't have more than up to 20% down payment. Now, with anything of less than 20% requires mortgage insurance, and there are different rules, different coverages. As long as this loan amount up to $1,089,300, its conforming limit, you can buy this property with 5% down. 3% down is also allowed, but the loan amount has to be less, which is $726. If it's a FHA loan, you can buy it with a 3.5% down. And there are different rules and different numbers. If you're putting 5% down, then property doesn't have to be FHA approved. If it's condominium and you have 3.5%, then yes, it requires FHA approval, which takes maybe 2 months to enable you to get it, and only then you can get FHA loan. However, if you're buying a house in these numbers, yes, FHA can be one of the options. There are many nuances. For example, question is what amount, how it's calculated. Amount depends on loan to value, obviously. In other words, it's a risk, and the risk is measured in dollars. And also in your client's FICO score. So FICO score also determines how much amount is going to be on monthly basis. If it's conventional loan, there is no upfront mortgage insurance. If it's FHA, the upfront mortgage insurance is 1.75% and renewal 0.55. Now, 175 usually is financed. In other words, even though you put only 3.5% down, this 1.75 is added to the loan amount, and therefore it's financed through the rest of the loan. Can you cancel the mortgage insurance? Yes, you can on conventional loans when value will drop to 80%, or certain formulas there is a 75%, but basically when it reaches 78%, it's automatically can be reduced or removed. If it's 75, yes, you just request lender to remove it and it will be done. You cannot do it on FHA loans. So in both cases, you can get rid of this when value will go up, and then property will appraise for at least 80%. Then you can refinance and get, when the interest rates will come down, then you can refinance and get different interest rate and no mortgage insurance. This is a very simple approach. And now, what's the benefit? The benefit is the clients don't need to have so much down payment. Another benefit, if let's say a client has 20% down, but they need money to fix the property, then they put, let's say, 10% or 5%, and remaining money stays in their bank, and when they need to fix the property, they have the money. If you do FHA loan, there is another advantage. FHA allows higher qualifying ratio. It goes up to 57%. So it's basically numbers. We play with numbers. We decide which number is more beneficial and which lender, which program fits the client's needs. Then there is another program, which is lenders call it lenders paid mortgage insurance. It, in essence, is increase of interest rate. Lenders, if you're putting less than 20% down, lenders increase the interest rate. They use the difference in interest rate or monthly payments to pay mortgage insurance. And this way, borrowers they don't have separate mortgage insurance payment, but rather they have one payment which has interest deductible. So there is an advantage. So each situation has different solutions. We use those numbers just to play around when we decide which program best suits the borrowers. Then there are other programs which allow us to do it, but then there is I would say, completely different option. Sometimes when purchase price is higher than 1.1 or you don't have enough money for down payment, you can do a jumbo loan with mortgage insurance. But it's tricky. It becomes trickier, and basically we stay away from this. When it comes to jumbos, we rather do a first loan and a second, which is completely different technique. Now, it might be confusing, but it is not. It's relatively simple, and the only way to understand what it is to call me. Well, you don't have to call me, you can call somebody else, but somebody has to explain to borrowers what's the pluses and what's the minuses. Thank you for listening. My name is Manny Kagan. I'm a mortgage broker, and you can always reach me by mannykagan@comcast.net. Thank you, and bye-bye.